welcome to the Bordeaux Blend, where we're blending expert ideas and tools to help people improve everyday financial decisions. Today, we're talking about crypto and blockchain technologies and their associated misconceptions and opportunities. And I especially wanted to have this conversation now that crypto's gone a little bit out of favor. Easy to have the conversation in late 21, for example. Everything's going very well. People are making money hand over fist. But now, given where we're at in the hype cycle, the tide has gone out, so to speak. We could see who was swimming naked. An important time to have that conversation. And to aid in that, we're joined today by entrepreneur and investor Avichal Garg, who has started and sold companies. You've been an angel investor, funded some very notable companies, ones that I'm a huge fan of as well. And I think in somewhere aggregate now close to worth $100 billion or so in market cap. And professionally investing as a founder and general partner at Electric Capital. So Avichal, thanks for joining us.
Good to see you. Thanks for having me.
Yeah, absolutely. So I wanted to at least just start things off a little bit more about your background in Electric Capital, really where your focus is there. You've obviously had success in more of a traditional venture sense. Why the shift to crypto, Web3, blockchain technologies, companies in that space very specifically?
Yeah. Well, we looked at it kind of, when we started the firm in 2018, but we've been personal angel investors in a number of companies since maybe 2014. We started angel investing, and we had a personal interest in crypto technologies, things like distributed systems, cryptography, privacy preserving technologies, ever since undergrad and grad school. But we actually back in 2010 were doing some Bitcoin mining. We'd come across some Bitcoin miners. We were doing a sort of a mobile infrastructure startup where you had to have GPUs and data centers, which is, again, a hot topic, actually, 10 years later. But while we were doing that, we came across a bunch of Bitcoin miners. And we actually, because my co-founder and I have engineering backgrounds, we misunderstood Bitcoin at the time in 2010. We interpreted it as a form of being able to purchase computational power on a distributed system. So the idea was, if I want to run some code, I can just buy some computational power on the system and somebody will run the code for me, which is not what Bitcoin is about at all. And we ended up mining some Bitcoin and playing with it and then sort of setting it aside. And then in 2015, we saw Ethereum, and we said, this is actually the thing that we thought Bitcoin was 5 years ago. This is a way to run code on a distributed system in a sort of permissionless cloud. You might call that serverless or something, kind of in infrastructure land today. And that sort of caught our eye. And as we sort of tried to understand it, we said, well, what is this actually good for? Like, what could this actually be used for? And what we came to believe pretty quickly was that what was really interesting about it was that it was a really effective way to move money. And it was perhaps the equivalent of what had happened on the internet for communication. This new stuff was going to be for moving money around. So if you think about kind of pre-internet telecommunications networks, they were very regionally bound, right? So like even early, think about early mobile. You could send a text to somebody in the United States maybe, but even sending a text to Canada made no sense. Or this is why Skype took off in Europe, because you had these sort of artificial geographic boundaries, and the internet was just sort of a network on top of all of those networks. And then you could reach anybody in the world. And that's kind of what our opinion was for what was happening with crypto. We said actually there's going to be a sort of a network of networks that allows you to move money around and connects the world in a 24/7 money system. And so that initial insight then led us sort of down this rabbit hole of, well, if this is actually the best way to move money around, what's interesting about it is that you can now write code around that money. So as soon as money becomes ones and zeros, you can write code around the money. And if you can write code around money, you can actually recreate the entire financial system. You can actually recreate wills, trusts, escrow, REITs, HELOCs, mortgages, derivatives, securities, like all of these things, if you think about them, are basically a pile of money, some rules around who has access to that money, and some set of instructions that you need to execute for 5, 10, 20, 30 years about how the money moves around and who gets that cash flow. And we said, well, now you can just write code to do that. So instead of it being 100 pages of legal documents, that could actually just be code, and everybody could fork the code and it can be open source, and you could write code to do all these things. And that sort of led us to believe that if that happens, what's going to happen is all the capital markets of the world will become 24/7 pools of liquidity on chain, in the same way that all the information networks of the world went from being sort of these newspapers to being 24/7 information networks online. And if that happened, we said, well, what will happen is that venture capital will have to move on chain as well. because venture capital is just another form of capital deployment. And so there's nothing that prevents venture capital from being disrupted by this new infrastructure. And historically, when you look at when venture capital when any industry gets disrupted by sort of this, if you know this Andreessen phrase, software is eating the world. Whenever software eats an industry, what you tend to see is that the firms that win in that industry are the ones where the internal guts of that organization were built to empower the people who understand software. And so look at Tesla versus legacy auto manufacturers, or you look at YouTube versus CNN, or Amazon versus Walmart. And Amazon's a 30-year-old company now. So Walmart has had 30 years to figure out e-commerce, and they've really struggled to do it. And I would assert that it's because what Amazon did was they just put the engineers in charge, and they basically built an organization where the engineers decide how you do customer acquisition, they decide how the partnerships work, they decide how to turn the levers to drive gross margin. And so all of your sort of critical business levers get driven by software. And at Walmart, that's just not organizationally how the business is set up, right? You have all this sort of legacy relationships with Procter & Gamble and warehouses. And so we said, okay, well, we know the venture business. We've done startups. We've done early stage investing. But we know the startup business. I shouldn't say we know the venture business, but we know the startup business. Maybe what we are qualified to do here is actually build a new kind of venture capital firm that from the ground up empowers the people inside the organization who understand software the most deeply. And so that's what we sort of set out to build in 2018. And so, we're now 30 people, depending on what you think crypto is worth, we manage somewhere between $0 and $2 billion. So if you ask Charlie Munger, we manage zero. Right. But, and of the 30 people, all 4 of the general partners, we all have undergraduate and graduate degrees in computer science. We have about 20 folks on our product and engineering team. We have built a lot of proprietary data systems. We built our own portfolio management and tax software to be able to do all this stuff on chain, because there's just no third-party tooling available to actually track your assets and understand what's happening with them. And there are all sorts of really interesting yield generation opportunities, and just tracking that and paying your taxes on that properly is non-trivial. So there's a team of engineers that builds that. We build open source software that we share with the community, which drives sort of brand awareness and deal flow for us. So we set out to build that firm, and we're about 5 years in now. It's still, venture is a long game, so it's still a little early. I mean, I don't think we can yet say that we're actually good at this, but I think we're off to a pretty good start.
Yeah, good. There's one story that you told recently, and I was listening to a talk that you gave at a presentation that was hosted by Khosla Ventures, and I think this is a really relevant example because we work hard, I think, to connect something that is known to something that is unknown, like the traditional banking system. And everything that you're talking about and focusing on. And you told this story of SBF, excuse me, and the hedge fund that he was overseeing, Alameda, and really how that played out over time with utilizing things like smart contracts and margin calls, and the difference between traditional banking and utilizing some of these pieces of software that you're talking about to enforce some of those rules. So could you just kind of rehash that for us briefly and talk about why that's relevant and what were the underpinnings of all those systems?
Yeah. So maybe 2 bits of history. So one bit of history is, the roots of this industry really come out of the 2008 financial crisis. And what happened was there was a person or persons named Satoshi Nakamoto. That's the name that they went by, at least. And it was very clear from the Bitcoin white paper that they wrote in 2009 that 2008, that they had a very deep understanding of computer science, but also of how money works and how the banking system works. And they're very, very insightful. And so I would highly recommend anybody who hasn't read the Bitcoin white paper to just go read it. It's like 10 pages. It's actually quite accessible, which again is sort of an insight into how brilliant this person was. And so it was very likely 10 to 20 years of thinking that this person synthesized into this white paper. But the moment that they decided to sort of release the white paper and then start writing code to start Bitcoin was in the aftermath of the 2008 financial crisis. And what they did was they looked at this system and they said, there was a massive systemic failure here. The banks all screwed us. And what they did was they had an incentive to give money to a lot of people that probably shouldn't have been getting that money. And then they marked up a bunch of assets that were illiquid that shouldn't have been marked the way they were. And there are all these sort of human incentive structures in the middle about how compensation works or who's paying who or how the money flows that were opaque that nobody knew about. And so very few people understood the leverage. And all of these sort of human failings led us to a point now where the system is collapsing. And from a computer scientist perspective or an engineer's perspective, you see this in software businesses all the time. And the engineers will stand up and say, you know what, let's just rewrite the code base. Let's just reboot it. We've learned a lot about how it works. Let's scrap the old way of doing it. We'll rebuild it and it'll be 10x better. So that's a very sort of common way for engineers to think about the world. And so Satoshi basically said, well, what if I could actually rebuild the underpinnings of the financial system? What if I could actually enable peer-to-peer money transfer that doesn't require these massive institutions, these banks, and these very, very large entities? And I think that was a brilliant insight. And it's that's what catalyzed this whole industry. So that's sort of one observation. Historically, this is actually the roots of this industry. Two is with Sam Bankman-Fried and FTX, and that's going to be like a Bernie Madoff level scam, just outright fraud. And Alameda was the hedge fund to which they basically took client funds from FTX and they handed it to Alameda. So effectively just stole the money. So nothing to do with crypto. It's just sort of good old fashioned fraud. What was interesting was that the way Alameda was operating was they were taking these user funds, sometimes in the form of cryptocurrency, Ethereum or US dollars, and they would go to OTC desks or they would go to third parties and use that as collateral to borrow money and lever up. What they were essentially doing was handing over collateral that was highly volatile or sometimes extremely illiquid, convincing these humans to mark those assets at very high marks, which, if you were forced to liquidate, you would not be able to actually recover that, borrow money against those assets. Now, what they also did was, in some cases, they took some of their assets and put them into decentralized crypto lending protocols, where the smart contract is mediating this sort of lending behavior between participants on chain. And when it came time for all these trades to unwind because they were getting margin called, what Alameda was able to do was pick up the phone and call these OTC desks and say to the OTC desks, hey, we're Alameda, we're backed by FTX, Sam's our chairman, he started us, you know us, we have this $30 billion equity company over here, like we're totally good for it. Give us a day or two, we just need to move some funds around on our side and we're good for it, just give us a couple of days. And a bunch of these humans basically said, okay, that's fine. We're not going to force margin call you the way that the contract says we should and liquidate you, and we'll give you a little time. Meanwhile, the smart contracts on chain said, nope, like there's nobody to call. There's nobody to negotiate with. Like you're going to get margin called. So you better either top up your margin to have enough collateral or pay back your loan. And so interestingly, the people who are inadvertently, not whether they realize it or not, lending money to Alameda during this whole FTX crisis all got paid back on chain because there was nobody to negotiate with. So essentially the smart contracts don't have this human failing of, oh, trust me, I'm good for it. They said, nope, the contract is the contract and I'm just going to move forward on it. And if you look at kind of where the lawsuits are, all of the people who ultimately lost money ended up being collateral damage of these humans making bad decisions along the way and not margin calling when they should have and taking collateral that they shouldn't have been taking and marking that collateral inappropriately and so on. And so in a sense, we recreated all of the mistakes of 2008 with FTX. And so, people look at that as a crypto failure, but actually if you look at what happened, the people that were actually using the crypto protocols got their money back. They were not harmed in this at all. The people who got harmed were the people who were using the centralized traditional financial institutions because they repeated the failures of 2008. And so I look at that and I say, wow, that's really interesting that these crypto protocols, they effectively behaved like the senior equity holders or the senior debt holders here, right? Like they got paid back first, which is pretty remarkable actually. And so crypto did exactly what it was supposed to do in that context. Like everybody got paid back and the losses, were de minimis. Now that's not to say that the smart contracts don't have other trade-offs. You can have bug in code and there's hacks and there's other exploits. But to me, it's really interesting because actually, 10, 15 years later from the original sort of Bitcoin insight, smart contracts actually do basically what they were intended to do, which is the code does what it says it's going to do and the money moves the way it should and there's no human you can call. And so they sort of patched the failures of 2008 and it's sort of actually doing what it was intended to do now, which I think is pretty remarkable. That actually, when you kind of look behind the scenes, this stuff, people ask about what's the use case or, what are the use cases here? And I say, there's $150 billion of USD sitting on chain now. There's $40 billion worth of Ethereum and other stable coins locked in these sort of lending contracts and financial protocols. And if you add that up, it's about $200 billion worth of assets, which would make Ethereum something like the 20th largest bank in the United States, which is real. And so, you start looking behind the surface a little bit and you actually realize the FTX failure was a 2008 style failure and a Bernie Madoff style failure. It was actually sort of the proof point. In my opinion, is actually proves the point. Like this is what all of this stuff was intended to protect against. And And this, when you look beneath the surface, actually, like none of that technology was being used here, which is why you had this mode of failure that you did, which is the exact same mode of failure we had in 2008.
Right. And you're going to have these hype cycles in between, but there's this longer secular trend of, hey, this is something that's around to stay. We're seeing BlackRock and other big institutions try and make a move here for something as well, too, that will be a little bit more permanent. And I think if nothing more, that is a clear indication that regardless of what happens, that is here to stay. When people think of this space, I think they typically just think of Bitcoin and Ethereum. Obviously, there's more to it than that. We just talked about smart contracts. But when you think about cryptocurrency more broadly, can you just help people understand, what are the different components of these currencies? Of course, there's multiple parts that make them up, but what are unique to that individual currency? And then what are some of the shared assets that comprise these different currencies that people might invest in?
Yeah, cryptocurrency is a little bit of a misnomer in and of itself, because that sort of makes people think about like, well, what do I do with the currency? It's sort of a medium of exchange and a unit of account, and I can go to like the store and buy stuff with it. And they do have some of those properties, but it's a little bit of an overloaded term. So I think there's kind of, like at least from the technical perspective, the way to think about this is just another software platform. This is just a way to write code and ship the code. It just so happens that the technical architectural decisions that the designers of these systems have made make them a uniquely good fit for certain kinds of problems. So these kinds of systems, at least in the way that they're organized today, not the best for building a high performance Web 2, social network type of product. But what they are really good at is when you have a distributed system and you have an open ledger that anybody can read from and that you can verify yourself, and that requires distributed consensus in order to move assets around. What you actually have is a permissionlessness, which anybody can sort of participate. It's 24/7 global. It's censorship resistant, which is to say that because it's a distributed system, one person can't come in and just decide to do something, or there isn't one single intermediary. It's not like PayPal can just shut off your account. And so what you're really doing is you're trading off efficiency for redundancy. You're trading off efficiency for resilience. You're trading off efficiency for seizure resistance. And then the code part of it is just essentially smart contracts are just little bits of code that you can write that will be executed on these systems in a permissionless way. So you can just write code and put it out there, and then anybody can use the code. And because the underlying distributed systems are very good for solving problems that require censorship resistance or seizure resistance and redundancy and resilience, it turns out things like money are a very good use case, because when you're talking about moving assets around, you want it to be censorship resistant and seizure resistant. Like you don't want somebody to just take your money, and you want it to be, you're willing to, if you're going to buy a house and it's a $5 million house and you're going to move that much money around, you're okay if it takes 30 minutes or an hour. Like it doesn't need to happen in 30 milliseconds the way Google search needs to be 30 milliseconds. And so it turns out like the money space in the financial sphere is a really good starting point for the application of these technologies with distributed systems and cryptography and smart contracts. Because money-related problems, you're willing to have a little bit of inefficiency to make sure that it's done correctly and make sure that it can't be undone. Like when you hand somebody the money, like the house is yours and so on. And so that's really the lens at which I look at this through. It's a way to write software that is on a distributed system and is permissionless and happens to be very good at being resilient and seizure resistant, which is uniquely good for certain kinds of problems. And then what we'll tend to see here, I think, is just like any disruptive innovation, over time, it will get better and better at solving more types of problems. And so, for example, if you look at NFTs, non-fungible tokens, these are essentially digital property rights. And so there's a cryptographic signature that says I have the right to some asset, and any computer program can verify that. So a video game could verify that, and I could say, oh, well, I own these items inside this video game, and the video game could verify that. But because I have that cryptographic signature, I could take those NFTs to another game, for example, and that new game could verify that I actually own those assets and potentially give me new assets in their game. And all that to say, this infrastructure, though, it's going to, in our opinion, start with these really basic financial primitives of how do I send you money permissionlessly peer-to-peer? How do I write some code around that to do basic lending, which is a very basic function of any economy? It very quickly spills over into things like assets and digital assets. It very quickly spills over into, well, if this is a peer-to-peer payment system and I'm a creator online, if I'm an artist or a musician, Does that mean any of my fans can just pay me directly? It does, in fact. And that's why so many artists are so excited about things like NFTs, because it's actually just solves a business problem for them. Because right now, a YouTube or a Facebook or Spotify just takes so much in the middle, like the cut, or even Apple, they take 30 to 60% of the money that flows between the fan and the artist. And so a lot of artists are looking at this as a monetization path, where if you have 1,000 fans, there's this old Kevin Kelly article. Kevin is the creator of Wired magazine. And he wrote an article maybe 15 years ago about your 1,000 true fans, and how one of the promises, it's actually probably closer to 20 years ago at this point, but he wrote this article basically about how on the internet, one of the most amazing and powerful things about the internet is going to be that your 1,000 true fans can find you. And so if you're a writer, those 1,000 people that are willing to pay you $50 a year can find you, and now you're making $50,000 a year, which is probably more money than most writers make, right? Or if you're really good, a couple of thousand people might find you at $50 or $100 a year. You could actually make hundreds of thousands of dollars a year producing your art. And the reason that didn't happen was actually the hard part of that is the money movement. Like, people can find you can find anybody, but the money movement was the hard part. Like, how does somebody in Vietnam pay somebody in Thailand? How does somebody in the United States monetize all their fans in Europe, right? It turns out that the global money network didn't exist yet, and that's what exists now. So all these creators are looking at this. So to answer your original question, these are distributed systems. This is cryptography. These are smart contracts. Like, these concepts, distributed ledgers, like, this stuff has existed for a long time. It's now been packaged up in such a way that anybody in the world can participate permissionlessly. And as a result of that, it ends up being a very uniquely good fit to move money around, which needs things to be resilient, and you're willing to trade off some efficiency for it. And once you can move money around, you start unlocking all these other adjacent problems, like the creator economy or marketplaces that need money movement. And so our opinion is it sort of spills over organically into a lot of these adjacencies over the next 10 to 20 years.
Yeah, and I want to come back to some of the misconceptions that I think that people have, but we had an event recently that I think helps people understand the value a little bit more and makes it a little bit more real, when we had this banking debacle with SVB and First Republic, and this happened in such a short span of time, given how quickly people can communicate now. We basically, happened over the weekend and came in to the office on Monday morning, and we're talking to clients over the weekend. Like, what is the safe thing to be in? People were worried about money market funds. They were worried about bank balances. They were worried about not being able to access that. You had people that were running companies that now couldn't make payroll. And all of a sudden, this thing just started to come up and resurface again, and people saying, look, where maybe I thought there wasn't necessarily intrinsic value here before, the value is really in the ability to hedge against circumstances like that, where I can make payments directly to somebody else if I need to. I don't need to worry about some kind of intermediary, their internal controls, how they're, marking assets to market, or having these, held to maturity accounts, or whatever the case might be. But really, coming back to a couple of those misconceptions, I think there are kind of two that come up a lot. One, you touched on this a little bit already, but, being a store of value, and how do people think about that dynamic being one. And then the second is, store of value, and then also being a good investment. And in order to be a good investment, it needs to have, some inherent value, some intrinsic value associated with that. And the market will, according to buyers and sellers, basically set the price of whatever the fair market value of that asset is. So could you both talk about, this stability dynamic that many people have had an issue with from the outside looking in? Maybe that decision is informed or not informed, and then also from the standpoint of the intrinsic value of these types of things.
Yeah. Okay. So a lot to unpack there. So first, maybe we just scope it specifically to Bitcoin. And then we can talk about Ethereum and US dollars. And I think your SVB example is a good starting point. I think what a lot of people realized during the SVB debacle is that maybe there's room for a non-custodial or self-custodial place to put your money. I think that was sort of a little bit of a light bulb that went off in people's heads. It's like, well, when I hand my money over to the bank, what happens if the bank does something stupid with it? I don't have it anymore. So then the government needs to step in and do that. And you've seen similar catalysts in other places. This happened with Canadian truckers getting shut off by the government. This happens overseas all the time. If you talk to anybody from Turkey or Lebanon or Brazil or Nigeria, places with intrinsically very high inflation and where they have had currency crises over multiple decades. And those people intrinsically all understand what I think the Americans are now starting to understand is that there is this tail probability, a small probability, that you could actually lose all of your assets. And as soon as you hand all of your money over to a trusted institution, what happens if that trusted institution fails? Like, yeah, technically you might have the money, but like to your point, what if I can't get the money for 30 days? What if I just can't access it? And I have to go through court to actually get all my money back. And so there's a lot of pain there. And a lot of that is a side effect of the fact that the technology, when the banking systems were created post World War II, or in the 70s when we sort of first digitized these things, was a certain degree of evolution of computer science. And so all the technology that we created over the last 50 years in distributed systems and public-private key cryptography just didn't exist. And so we actually now have the ability to build a better banking system where you retain custody of your assets if you want to. And I actually think that's where the world will end up here over the next 20 years. I think we'll end up with a financial system where you actually have custody of your assets and the bank can't unilaterally move them. And that means that they can't lose them. And if you ever want them to generate yield, then there are ways to do that where you can still get your money back. And you can see on chain what's happening. So anyway, a lot of the sort of failures of the existing system, I think they're not, there's a set of human failures, and then there's sort of a set of properties of the system that emerge from the technical architecture of the system. And so when you're talking about Bitcoin, I think the right way for most people to think about it is it's essentially an insurance policy. It's not a store of value yet. It might be one day. It's sort of at best a prospective store of value. But it's really an insurance policy is I think how most people should think about it. And that is how a lot of the world thinks about it. The closest thing to a store of value for most of the world is either probably gold or the US dollar. That's what actually most people want. But I think a lot of people recognize that something that is not tied to any government in the world does have a place in a portfolio. And I think that's sort of the realization that the BlackRock ecosystem has come to, is that a lot of the world has realized that. And so the capital inflows can be significant because a lot of people want some sort of asset that is not tied to any government. Now, relative to sort of the second part of your question, there is a lot of volatility there, which is why I think it's tough to call it a store of value relative to the US dollar. But the question I always ask people when we sort of talk about this, the question I would ask a skeptic is, well, would you rather have Bitcoin or would you rather have Venezuelan Bolivar in your portfolio? Or would you rather have Turkish lira or Brazilian real? Like, I would certainly rather have Bitcoin. And so then you start looking around the world and you say, wow, there might actually be 1 billion people or 2 billion people who would much rather have Bitcoin than their local fiat. And then the light bulb starts to go off a little bit, which is like, yes, relative to the dollar, maybe this thing is highly volatile. But actually, if you hold this relative to Argentinian pesos, you're way up. Like you're winning here. And then they start to say, okay, well, so it's not actually that it's not a store of value. It's a store of value relative to some base currency. And then the question is, well, how would it need to perform relative to your base currency, the US dollar, for this thing to be compelling? And is there a path for that to happen? And obviously, not financial advice. Everybody should go do their own research on this stuff. But the way we think about it is there's certainly a potential path there for that to happen. And there is precedent for these sorts of things. And so we tend to look at it as more of a tail risk insurance and more of a commodity today that trades based on supply and demand dynamics and some speculation of who else is going to have some demand for this thing over the next 5 to 10 years, more than any sort of true store value. But it turns out speculative activity is an amazing bootstrapping mechanism for a lot of people to come in, buy, and then not want to sell because it's actually better than their alternatives. And so that's historically what we've seen happen. So for the last 10 to 12 years with Bitcoin specifically, what tends to happen is you have this sort of speculative mania, a bunch of people buy, it pulls back big time, 80, 90%. But a lot of people who hold the thing say, well, even if I lose 80% relative to my base currency that's inflating away like crazy, I'm still way up. And so I'm just going to hang on to this. Or relative to my tail risk, I'm willing to hold this insurance. And so you get this entire sort of, it's almost like if you look at layers of sediment, you get this sort of like sedimentary layer of people who want to hold this thing and not sell. And then once all of those people have acquired and all the people wanted to sell have sold, at some point a new group of people realizes that there might actually be value in this thing, and they come in and buy, and sort of a new cycle begins. So we're in the down part of the cycle right now, but historically what that's meant is that it's just supply moving over into the hands of people who don't want to sell, and then when there's no more people left to sell, there's only buy demand, and then there's usually some catalyst, whether it's Fed rate cuts or a currency crisis somewhere, or new pools of liquidity realizing that this might make sense in a portfolio. So perhaps next time that's the BlackRock ETF, but that catalyst then brings in a bunch of new buy demand, and because nobody wants to sell, it drives up the price. Like each marginal dollar has to bid a lot more. So it behaves a lot like a commodity. But you could certainly imagine that over, a 10 or 20-year period, that so many people have bought in at such a high price that the volatility goes down. And historically, that's what we see, in the volatility sort of gets dampened, that it eventually becomes some sort of store value. So that's how we think about Bitcoin specifically. It's a long answer. Beyond Bitcoin, I think, it's a lot of open questions about whether Ethereum will have some sort of monetary premium, and does it behave like a base currency or some sort of reserve currency for this digital world? I think there's an argument that it could behave sort of something like a base money for this ecosystem. The evidence for this might be, for example, if you look at the NFT ecosystem, which sort of behaves like a combination of collectibles and like baseball cards or Pokemon cards, and luxury goods like like a Birkin bag or a Rolex. It has a lot of those same sort of properties, sort of social signaling and Veblen goods sort of properties. That if you go talk to those people in that ecosystem, they will denominate their assets in ETH, in Ethereum, in Ether, which is a really interesting phenomenon. And so you already actually see some evidence that might be the case over time. But if you look actually at the probably single biggest use case and killer use case on top of Ethereum right now, it's stablecoins. It's the ability for the world to access dollars on their phone, because the U.S. does not have a central bank digital currency. And I don't think we're on path to actually building one. I actually think we're on a path from a regulatory perspective for the U.S. government to embrace U.S. dollar stablecoins, because the U.S. dollar is a tool for national security. And so what the politicians are starting to realize, and what folks in the national security apparatus have realized, is that if you can get dollars into the world, you basically have a financial nuclear weapon that nobody else has. This is why, for example, the U.S. is able to do sanctions on Russia or Iran. It's because the world runs on the U.S. dollar and the U.S. banking system. And this is just another tool in that toolkit. And so if you could actually get dollars to proliferate into the world, into the hands of every person in one of these countries, you have a tremendous strategic asset. And so what's starting to happen is that the government is starting to realize that getting dollars into the world is advantageous. And so the politicians are flipping pro stablecoins. And so the killer use case on top of Ethereum, actually, in my opinion, is stablecoins to start. But it goes back to the same fundamental observation, which is that probably most people listening here would posit that most people in the world would love to have more access to dollars, and they probably can't get easy access to dollars. But once you have dollars floating around on this architecture and this infrastructure, and anybody can write code against those dollars, then it's basically inevitable that people create lending markets, and they create swap markets, and they create interest rate swaps, and they create treasuries, and so that yield from offline treasuries flows into this world now. So you can make 4 or 5% in this new world with your U.S. dollars. So all of that sort of financial plumbing, the floodgates open as soon as you have stable coins, and now you have $150 billion of those. And I think it's inevitable that the U.S. sort of does that. So you kind of have two, when you're talking about store of value, you kind of have two things happening in parallel. There's sort of this Bitcoin behaving like a commodity driven by supply and demand dynamics. Could it potentially be a store of value one day? Perhaps. And it really sort of behaves like an insurance policy. And then in parallel, you have the Ethereum ecosystem happening, which is actually US dollar denominated, because so many people in the world want dollars, and this is the fastest, easiest way to get dollars. And out of that, you're sort of seeing the springing of a new financial system that's 24/7 and global, sort of like the internet of money, and sort of springing out of that ecosystem. So these two things are happening in parallel.
And given that much of this market is tailored towards maybe hedging against some long tail event, a big, you need that to work when it works. I mean, that cannot fail if that's basically your last resort. So what are some of, I know there are things like multi-signature protections. What are the other privacy-based tools and safety mechanisms that are inherent there that people can and should be aware of if that's really the use case?
Yeah, it's a really good question. So, I think there's sort of two things there. So one is, understanding self-custody and public-private key cryptography, and how you can custody your own assets if you truly do care about this tail scenario. It's the equivalent of having, some gold bars or something, or gold coins, or, owning some fine art or some Rolexes or some Pateks that you sort of have in a safe, which is it's self-custodial. It's a highly liquid market. It's 24/7. And the whole idea is to not hand it over to somebody. There is a little bit of a user experience barrier there. In my opinion, it's worth understanding and worth learning, if only, partly for the insurance properties, but also I think because if you do think there's a chance, some probability, some non-zero chance that this stuff is real over the next 10 to 20 years, and we're in the very early days of that sort of internet of money transformation, then the thought exercise is, well, if this were the early or mid 90s, and you could see the internet was going to happen over the next 20 years, what would you do? Well, you would probably get a Prodigy or an AOL account. You would start to learn how to use a modem and dial in and learn to use the internet. You would probably try to buy something online. Like, you would just use it to understand what's going on and what you should do about it and really internalize that. So I encourage people, even if it's with small dollar amounts, to try to buy some Bitcoin and move it into their own wallet, or buy some ETH and move it into their own wallet and just play with it. So even playing with it for a small dollar amount that you might lose, I think, is very instructive. You start to understand how powerful it is for you to own your own assets, that nobody potentially even knows about, right? And there's a whole sort of branch of this world around privacy technologies and cryptography, sort of the original crypto, if you go talk to PhDs in cryptography, that makes these things highly private as well. And so nobody needs to know that you have them, which is I think, an important feature in the world. So, I think that's an exercise I think everybody should do. Now, I think where the world is likely headed is there are definitely some challenges with that. There's some risks with that, which is if you lose your private key, then you've lost your assets, and that's a real risk. And so there have been some breakthroughs over the last several years in the underlying cryptography that allow you to do really interesting things. Like, these are called multi-signatures. And so what you could do is you could say, I, as an individual, need to sign off before the money is moved, but Coinbase could also be the second signature, or my wife could be the second signature. And so what you now need is 2 out of those 3 people, it would be called a 2 of 3 multi-sig. 2 out of those 3 people need to agree to move the transaction before the assets will move. And what's really nice about something like that is I can sign off on it, and my wife can sign off on it, and then the assets can move. Or that could be a trustee, or it could be a lawyer, right? It could be some legally obligated third party, or a nonprofit that holds this as a backup. And that means, like, Coinbase is not involved in the transaction at all. Or it could mean that I can just do that with Coinbase, right? But it means that Coinbase can't take my money, right? If you know, like, Coinbase would have to collude with my wife or with my lawyer to take my money, right? And so it's actually sort of intuitively, you sort of realize, like, that's actually how people would prefer their assets to be. Like, you kind of get all of the nice properties, right? You can have it be self-custodial, which is like you can just move your money around. If you lose your key, you can go to your wife and go to Coinbase and say, hey, sorry, I lost my password. Like, can you guys move the assets and let's move it to a new wallet where I have the password. So you get password recovery kinds of benefits. You have the efficiency of, if there's some company like Coinbase that your wife doesn't want to be online 24/7 and responding to your texts to sign off on stuff to move money, you and Coinbase could do it. Or your lawyer can't, is off on vacation for a week. And so you actually get a lot of the nice properties that you would have. And it sort of mirrors, if you've ever worked in a financial institution, you sort of have these checks and balances with, say, like wire protocols, where like some third party has to tee up the wire, somebody on the finance teams approves the wire, and then like the principal signs off on the wire. Except instead of it being sort of like, sitting inside some bank interface where you got to click a bunch of check boxes to like who has what permissions, it's all done through cryptography, and those assets are actually sitting in your device rather than sitting in a bank vault somewhere. And so you actually can recreate a lot of the benefits of the existing financial system, but actually get this additional set of benefits around self-custody as well. And so that's where I think the world is headed kind of over the next 2 or 3 years. And back to this idea, I think of, I think even if you did that with $100 and you got the Coinbase MPC, like self-custodial wallet on your phone, and you started playing with it, I think that would be the equivalent of buying some books on Amazon in like 1995 or something, right? It's a sneak peek into the future. Like that's how the financial system will work in 10 to 15 years for everybody. You can just experience it today.
Yeah. One of the things you described as you were talking that came immediately to mind with this multi-signature authentication is just elderly folks, right? Like that is something that is always in your mind, and people might think, hey, my mom's getting old, she's in her 80s, we've got a caregiver, I'm sure they're fine, but like I don't know where all these payments are going, and especially for large and consistent purchases or anything like that, being able to say, hey, look, my brother and I, or trustees or whatever, and 2 of the 3 of us, not just my mom, needs to actually approve this distribution before something happens there. So that's a very interesting idea. Just to shift gears here slightly, of course, we've had AI running through every single headline every single day, basically. But there seems to be an interesting intersection between crypto technologies and AI. What is that? And, as you think about that over the next few years, what developments do you expect to see? What seems to be most promising to you?
Yeah, I think basically these 2 things converge over the next decade, crypto and AI. And the reasons are twofold. So if you think about, AI is going to create a bunch of opportunities, and it creates a bunch of challenges. And as these AIs get much more sophisticated, the opportunities are pretty amazing, right? Like you can have a tutor for every student, so everybody gets their own private teacher. Everybody can have their own private doctor on your phone. You get just massive efficiencies, I think, in a lot of businesses, and that'll be pretty remarkable. And if you think about how that's going to work, it opens up some really interesting opportunities. So, for example, if you think about what an AI is, what is an AI? An AI is a really interesting thing that's kind of like a smart contract, which is that it's a non-jurisdictional, non-human, non-business entity that you can interact with. And that's a really weird concept. It takes a while, it took at least me a while to get my head around that. And I think the last time we had to sort of think about something like this was maybe, well, kind of originally probably about 1650 with a joint stock corporation, where the Dutch East India Company gets created, and it's a separation of risk from capital. And so I can put money into an entity, and my personal assets are not at stake, and the people who go on the ship and go on the voyage get some upside in the thing. And that construction of essentially a limited liability corporation in a joint stock corporation is a pretty amazing breakthrough. And by about 1850, the UK and the US realized that was a potentially really powerful thing. And why go to the king to get a charter to get a company? What you should do is be able to let anybody start a company. And that, in my opinion, was actually a big unlock for the Industrial Revolution. Like, not only from a technology perspective, but the ability to pool capital to pursue things like the railroads was really important. And it allowed us to do those kinds of sort of massive industrial undertakings. But we had to think through the consequences of that. And it took us a long time, right? If you think about that, you're like, well, what does that mean? Like, a business is not a person, right? And like, how do I interact with it? Who has liability? When? Under what circumstances? Like, how do we resolve disputes? There's actually a bunch of open questions there. So we haven't really had to think about something like this for maybe 200 years. And we now have to think about these kinds of things because these AI entities and these smart contracts don't live in a jurisdiction, right? So one of the side effects of these things being 24/7 global permissionless systems is that they don't live in a country. They live on a computer, and they live on multiple computers at once. And those computers can be in different jurisdictions. So effectively, a smart contract or an AI lives in the cloud. And we don't really have a jurisdictional framework to think about what that means. Like, if an AI does something bad, who's liable for that? Does an AI pay taxes? Because if not, a lot of people are going to hand their money to AI to do the things that they would do, but the AI is not going to pay any taxes. And if it pays taxes, who does it pay taxes to, and why? And so there's a lot of really hard open questions here that get opened up. And one of the interesting opportunities there, I think, is if you sort of start thinking about that, you realize that actually probably the money rails for an AI are going to have to be decentralized cryptographic money, because an AI can't go to a bank and KYC because it doesn't have a driver's license and it doesn't exist. As far as it's not an LLC, it's not a C corp. And so how does it actually access money? Because money is going to be very necessary for the AIs to be able to talk to each other. So if I want to buy data from another AI to train myself better, or if I want to call an API for some SaaS service to use their product, or if I want to buy more computational power, how do I do that to do what I want to do as an AI? And so that money interface is going to be really important. And if I can't go into a bank and KYC, I probably have to use digital dollars sitting on a cryptographic decentralized system, effectively command line money, where I can spin up a wallet and the AI custodies the money. Right. So actually, like, a lot of the problems that AI will need to solve will require cryptographic money, and therefore it has to use these decentralized cryptographic rails to do what it needs to do. It's also interesting because I think AI will create a bunch of challenges, things like deepfakes. Like, it now becomes very, very cheap for somebody to create a video saying that the president said to do a thing, or that you said that you said something terrible, and now it's on the internet. And so I think what we'll end up having to do is solve a lot of these problems that AI will create by being able to verify who did a thing. And so, for example, if you take a video on your phone, you could cryptographically sign that and register it in some sort of decentralized register that anybody can read from that says, Sean took this video. And so if somebody publishes a video that's doctored and is a deep fake, and they can't prove that it was taken from your phone, then it's a deep fake, right? And so when you look at that as a technology solution, you realize that things like authenticity of content, provenance of content, personhood, like is somebody actually a human? These are all problems that actually cryptography and distributed systems, like what does it mean to have a driver's license, right, in this new digital world? These are all problems that actually get solved by cryptography and distributed systems. So I actually think these two things converge over the next decade, because a lot of the challenges of AI, things like deep fakes, or who is a human, or can I trust this call that's coming in? Is it actually my mom? Or if somebody calls your mom and says, hey, I've been kidnapped, please send $1 million. Like, is that really you? All of these problems, actually, the way you solve them is through cryptographic signatures and decentralized distributed registers of who's who. And a lot of the interesting forward-looking opportunities with AI also require cryptographic money. They require the AI to be able to access a wallet and have funds and move that money around. And to be clear, I think it'll probably be US dollars, but it turns out the place where that's easiest and anybody in the world can then have their AI jump into it is probably on a decentralized blockchain that has US dollars. And those US dollars may very well be sitting in a US bank ultimately. But that ends up being the interface for the AI to interface with each other and for the AI to interface with humans. So I actually think over the next 5 to 10 years, these things converge pretty directly.
And given that they're converging, I mean, I think a hard part about that too, and I'm very curious to get your thoughts on this, is just the regulatory dynamic. I mean, that's coming up obviously with AI every single day. Crypto, it's definitely present. I would say less so in the headlines now, but there's obviously been a lot going on with Coinbase and Gensler and the SEC. How do you marry those two, or how do you think about that as these two converge and these different sort of regulatory approaches, dynamics, bodies between the two?
Yeah. So, well, at the highest level, it's hard. It's not easy. I don't envy the regulators trying to figure this out or the legislators trying to figure this out. I think it's hard. It's not insurmountable, though. If you go back to the internet, the Telco Act of 1996 was a pretty seminal piece of legislation. Like, we don't have the internet without that. And it's because it gave us things like Section 230, which allowed us to have this rule that said, well, the forums are not newspapers. They don't have editorial oversight of what the users put on the forum. As long as they take it down, if it's a copyrighted material, after the fact, that's okay. And by sort of setting that, we actually allowed user-generated content to happen, which is why we have things like YouTube or Wikipedia. Like, without that, those things can't exist. So, there is some precedent for us being able to solve these hard problems. So I think we'll solve them. And actually, if you look around the world, a lot of other jurisdictions like the EU just passed MiCA. The Gulf is very pro. Hong Kong has flipped and wants crypto companies there. When you start looking around the world, actually, a lot of other jurisdictions are moving very positively because they recognize the sort of size of the opportunity here to build a new financial rails of the world as a starting point. And so a lot of other jurisdictions are sort of doing interesting and positive things. And the United States is lagging in this regard. And when you look at that sort of one level deeper, you realize it's actually mostly an executive branch issue right now. We spend a lot of time with the folks in Congress and Senate, and there's been actually very positive movement in the positive direction there, and it's in large part because the USD the understanding that U.S. dollars on chain is a national security asset has sort of gotten a bunch of people to realize that they need to flip and support this stuff at least. And so Congress and Senate are actually moving positively. If you look at the executive branch, and the SEC is an appointed body there, that's not as positive right now. In part, I think it's not just a crypto thing. I think it's actually a philosophical shift that's happened with the executive branch. So, for example, if you look at the FTC or the OCC, the FTC just had this ruling against them in the Blizzard, Activision Blizzard Microsoft case, where they sort of asserted a bunch of things that were just not backed up by the law, and so they lost. The FTC lost. And I think what's partly happening is that there are very real problems in society, right? Wealth inequality is a real problem. It's a really big open question, the amount of power that the big tech companies have, the amount of data and oversight, and what's happening there. But the problem is we don't really have the rules. There's no legislation on the books that says, well, here's how you regulate a demand side monopoly rather than a supply side monopoly. Like, all of our monopoly rules are really set up with railroads and telcos in mind, not with Google or Facebook or Amazon, right? And so we don't really have the legislation yet, right? And so what the executive branch is doing, folks like the FTC, is they're saying, we don't like this. We don't like the way the world is headed. So we're gonna push the boundaries on what we think is okay to do. And then what's happening is the third branch of government, the judicial branch, is basically pushing back on them and saying, sorry, you can't do that. That's outside the bounds of what you're legally allowed to do. And so I think that's how this nets out. Is I think over the next 2 to 4 years, there's some court cases like Ripple and Coinbase. The Ripple rulings have gone very favorably for Ripple, I think, to some people's surprise, and against the SEC. I think it's very possible that also happens with Coinbase and SEC. But it's really, I think, a symptom of a broader issue, which is there's been sort of this philosophical shift in the executive branch that being more aggressive about these things and pushing the boundaries of what the law says you can do is the right way to operate, because they don't like the outcomes of where things have headed. which I understand, though I disagree with that approach. I understand why they're doing it. And the judicial branch is saying, sorry, that's you can't do that. That's not what the law says. And so really it comes down to, can we muster enough desire to fix this through legislation? And I do think that the national security implications of this stuff will take precedent, and then the U.S. will sort of do the right thing. And the rest of the world has already moved in this direction. So I'm actually pretty optimistic over the next 2 to 4 years. I think it's sort of a slog for the next 12 to 24 months while these things work their way through court. But if it eventually gets to something like the Supreme Court, there's a lot of pushback from the judicial branch right now on the executive branch, whether that's student loans or the FTC or whatever else. Like, you're seeing a lot of pushback there. So I feel relatively confident this will end in a good place over the next 2 to 4 years in the U.S. There's actually a great Churchill quote that I always keep in mind. And I'm going to butcher the quote, so go Google it. But it's something to the effect of, you can always count on the Americans to do the right thing after they do all the other things. And so, we're in the process. We're just in the process of working through all the other things, and then we'll eventually do the right thing.
Sure. Yeah, well, good. Positive note to end on there. I really appreciate the time. I mean, there's obviously a lot more to unpack here. Maybe we'll have to do a follow-up at some point. But just to round things out, if people want to learn more from this, where can they follow you? Any other good resources you would point them in the direction of?
Yeah, I'm just on Twitter is probably the easiest way to find me, just at Avichal, Avichal, or electriccapital.com. We're pretty easy to find. So we're at Electric Capital on Twitter, or electriccapital.com. So any of those places are pretty great.
Sounds great, Avichal. Well, thanks again. Really appreciate it, and look forward to talking again soon.
All right, take care.
Okay.
See ya.